Ladies and gentlemen, we have some new economic data that is absolutely terrible for the economy, but can you believe it? Terrible news for the economy is now great news for the stock market. Because what you have to know is the economy and the stock market are not the same thing. So a lot of people get confused or comment on the videos when I put out these reports that are showing the economy is doing so bad and say, well, Michael, the stock market surged today. Well, what you have to know is all the data we get on the economy is looking in the rear view mirror and the stock market is forward looking. But in today's video, I'm going to go over a new reason why the stock market is surging off bad economic data. And the reason why is your pain is now Wall Street's gain. Because remember, once upon a time, the stock market used to be based off fundamentals. When the economy was going great, people were spending, earnings were going up in companies' earnings reports. That was good news for the stock market. And that was when the stock market rallied. When there was a recession, the stock market would go down. But now in this new world of central banks printing money like crazy and dropping interest rates to zero, the stock market no longer cares about the economy. They now care about what is actually happening with the central banks. And with this new bad economic data, a lot of people on Wall Street are speculating that the money print is about to fire up again and they're going to drop interest rates to zero. But the stock market doesn't always get it right. So will they be right this time, or are we about to see another painful downswing? Well, everyone, that's exactly what I'm going to cover in today's video. This is going to have big consequences for you, so we definitely need to pay attention to what's happening right now. So everyone, without further ado, let's get straight into the news, the facts, and the data. Well, look at this, everyone. The US jobs market is finally declining, and Wall Street and the oligarchs, the 1%, the millionaires with their 10 properties and their $10 million portfolios are cheering on your pain. So look at this, everyone. US job openings declined to 8.83 million, lowest since early 2021. Now, on top of this, vacancies fell in July for the sixth time in the last 7 months, and quits rate decreased to 2.3%, the lowest since the start of 2021. But that's just the tip of the iceberg, everyone. Let's dive deeper in this report. So as we can see with this chart here, everyone, the number of available positions decreased to 8.83 million from 9.1 million in June. And we can see here the downtrend is accelerating, like what we can see on this chart here. So fewer vacancies paired with increased labor force participation have allowed for greater balance in the labor market and helped temper wage growth. Despite the easing in demand for workers, unemployment rate remains historically low. Another thing Wall Street loved on this report is, guess what? You're not going to be getting a pay rise, and they absolutely love that. So that way they can get a few more percentages on their stock portfolio. Now, don't get me confused with some socialist and someone that doesn't like free market economics and doesn't like people getting gains in their stock portfolio. That's not the case at all. I absolutely love that when it's going based off fundamentals. But with this new monetary system we have today, is the stock market only goes up when we have severe pain for the middle class and the working class. This trend has been key to growing hopes that the US can avoid a recession despite the Federal Reserve's aggressive rate hikes. Fed Chair Jerome Powell also suggested last week that should the labor market continue to loosen, inflation can keep on its downward path. The Fed is concerned that rapid wage growth might stoke inflationary pressures in 2024, but wage growth is likely to slow in the coming months, with workers seeing few opportunities to raise wages by switching jobs. Bill Adams, chief economics at Commercia Bank, said in a note. But you know what came to my mind when I was reading this report today is how screwed up this statement says. The central bankers in 2020 printed money like crazy. They gave hundreds of billion dollars to the banks, to these mega corporations, and we all saw inflation surging, and they were fine with that in the beginning, but it was only until the middle class started to get a pay rise that they were like, what? The peasants are actually getting some scraps from our, inflationary monetary policy. That's it. We need to tighten in the reins. This is called trickle-down economics. They give hundreds of billion dollars to the banks, to the mega corporations. They go ahead and lend that out into the economy, make you a debt slave. And once you finally start to get ahead, they then sell all their stocks at all-time highs. They crash the economy and come and buy up all your assets that you'll be forced to sell. Because remember, you're so highly leveraged in debt, or that's what I hope my listeners aren't doing, but that's what most people do. And then they repeat this boom-bust cycle. But guess what, people? If you know how the game is played and how the monetary system really works, you can use this to your advantage and get ahead of the cycle. Because once you actually learn how the monetary system really works, how money really works, how markets really work, how the banking system really works, you can get ahead of this Ponzi scheme that they're doing, and you can benefit from it because they rely on most of the middle class having absolutely no idea how it all works. But more on that later. So I'll go ahead and bring up another chart here, everyone. The highs declined to the lowest level since January 2021. The number of hires has dropped by 458,000 over the last 2 months, the largest decrease since the end of 2022. And we can see here, not only job openings are falling, but new hires are plummeting as well. So okay, we know the jobs market is starting to deteriorate, but that's just a first report. We got another report on top of this that confirms we are in recession territory. They just haven't called it yet. And I saw this meme when I was scrolling on the internet the other day, and I thought this was completely true. Look at this, everyone. Yay, after decades of hard work, I finally reached middle class. Inflation? I said you poor. Isn't that the truth? Well, guess what? This report backs up those claims that inflation is making the middle class poor because US consumer confidence is plummeting. So look at this. US consumer confidence falls by more than forecast in August. The drop was the biggest in 2 years, erasing most of the summer surge. High borrowing costs curbed sentiment, Conference Board says. So again, this proves, unlike the central bankers are saying, like a lot of people in mainstream media, and the analysts on Wall Street, they're completely out of touch with the middle class. The consumer isn't strong. They don't have strong balance sheets like they've been ramping on about, and they are in severe pain and only have enough to buy the essentials. They don't have much money left over there to buy on discretionary items or luxury items. So the Conference Board index fell to 106 this month from 114 in July. Data out Tuesday showed. The number was below all estimates in the Bloomberg survey. The decline reversed most of the advance over the previous 2 months. And I'll bring up this chart here. We can see again, as well as job openings, we're seeing consumer confidence hitting a 3-month low, and it looks like we're about to hit another downtrend. But what exactly is causing this? Now, we can also see on this chart here, a gauge of expected inflation a year ahead edged up to 5.8%. The central bankers aren't going to like that, marking up the first uptick in 5 months. While consumers have been enjoying some relief from abating inflation, still high prices continue to weigh on sentiment. And I completely agree. Every time I go into the grocery store, it's getting crazy. And also at the petrol station, at the gas station, we're seeing prices increase as well. Though economists have been pushing out their recession forecasts on renewed economic momentum, many are still anticipating a downturn in next year as consumers show signs of weakness under the surface, which I definitely agree. Now, again, we won't get that data till 6 months after the recession has actually happened. That's why you have to look at real world indicators right now, which I'll go over in a moment. Some Americans have been turning to credit cards to make ends meet, while others are cutting back on spending altogether. So what this simply means is inflation is surging, interest rates are still elevated, so this is putting a lot of things people want to buy out of reach. And all those savings or the balance sheet that are meant to be so strong for the consumer that maybe still have some savings left over from the pandemic, well, they're going to be completely drained, and we're going to see consumer confidence continue to plummet. And like I keep talking about, the fuse is going to make this economic downturn accelerate is going to be once we finally start to see the unemployment rate tick up. But okay, if I haven't convinced you enough that we are in a recession or facing recession, we got another report, bombshell report on top of this as well, which really puts the final nail in the coffin. So look at this, everyone. Our industry is in a technical recession. Dallas Fed manufacturing production hits new lows as prices spike. So as we can see here, anything under the orange or red line is in recession territory, and that's where we are right now. So Texas factory activity contracted again in August, according to the Dallas Fed manufacturing survey, with production index tumbling 6 points to -11. That is the lowest excluding COVID lockdown since May 2016. And of course, they completely shut down the world in 2020, so we can exclude that. So this is very depressed levels. Now, if we look under the hood, the picture is just as ugly, with new orders contracting more than a year, capacity utilization down, shipments tumbling, and a capex down to a 3-year low. Now, we have some great information here from some insiders in different industries, from food manufacturing, machinery, and primary metals metal manufacturing. So for the first time in a long time, we're seeing customers reduce or cancel orders due to softening end-use demand. We expect this trend to continue over the next few months. We continue to make capital investments, focusing on buying high-quality used manufacturing equipment at a discount when other people are pulling back because of uncertainty. Now, if we look at food manufacturing, we're seeing contraction in government contracts. Customer discretionary spending capacity has been decreased. If we look at machinery manufacturing, the phone is not ringing. Business is slowing down. If we look at primary metal manufacturing, our industry is in a technical recession. Finally, given all these comments, it is not surprising that Future General Business Activity Index returned to negative territory after pushing positive last month, coming in at minus 3.3. So people, I don't think you need any more proof. This is not me trying to, spread doom and gloom clickbait. It is just factual information. We are in a recession, but that doesn't mean the stock market is going to crash. If the central bankers start printing money like crazy, if they drop interest rates to zero, unless we have a financial crisis, which is definitely possible, or economic depression, far worse than a recession, we will see a stock market rally. But again, that's only if we don't have a severe depression or economic crisis, which is definitely possible. But okay, time for our last and most important unorthodox indicator that proves Americans are really struggling right now and we're in a recession. Look at this, everyone. Americans panic search live off grid as housing crisis worsens and Democrat cities implode. So I don't know about you, but I'm definitely seeing this. I'm seeing a lot of live off grid videos on YouTube. They're going completely viral, and we'll have a look at some of these here. So we can see here Peter Centello. He does a lot of videos lately on Appalachia, and we can see all his videos on Appalachia are going crazy. We can see here, poorest region of America, 16 million views. The man with no legal identity living off grid in Appalachia, nearly 10 million views. So this shows a lot of Americans, they're really struggling and are looking for other alternatives to, working 2 to 3 jobs, working 80 hours a week just to have a roof over your head. Because if you have to work 60 to 80 hours just to have, the essentials, what we used to have for free. Remember, once upon a time when people lived off a farm, they were self-sufficient, they owned their land, they didn't have these property taxes that are doubling every, year or 2 years. But then people said, hey, come to the city, you can get rich, come get a job and you can make it rich. And then you can finally, one day when you're 70 years old, go ahead and live out there in the woods, retire and enjoy life. Well, some people saying, well, screw it. I can't enjoy living in the city. I'm not getting rich. So I'll just go ahead, move to the country and live that quiet and peaceful life now. So everyone, I know you're thinking, well, okay, what does all this economic indicators and finance jargon mean for you in simple terms? Well, what this simply means is, everyone, we are in a recession. I think right now, I think we won't really get the real official news until mid-2024 because they always call it far too late. And what is happening in the stock market is the reason why it rallied today is because they're thinking, oh, all this bad economic data, that means the Federal Reserve is going to start printing money again and cut interest rates to zero. But remember, the stock market doesn't always get it right. They have been wrong again and again and again, but this is why the market rallied today. So how can you protect yourself against an economic recession, but also if we see a stock market rally? Well, everyone, what you can do, this is not financial advice, just what I'm doing is you can buy gold and silver to protect yourself against a recession or financial crisis or a severe depression. But if you want to get the upside of a market melt up, you can also buy Bitcoin. You could buy some mining stocks that would definitely benefit off a stock market rally, especially if gold and silver performs well too. And if you're worried about AI losing your job and you want to hedge yourself against that as well, maybe you might want to diversify a little bit of your portfolio into the NASDAQ 100 because all the best performing tech companies are in there. So one of them are bound to benefit from AI, what we're seeing right now. And that way you can protect yourself against that scenario if AI or suddenly enter a dystopia where they take all our jobs. But everyone, what do you think about this? Let me know down below. Now, for my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.